Hello Internet, and thank you for checking out Financial Journey, a channel on which I bring you the financial education that I never received growing up. Welcome back to my returning viewers, and a huge welcome to anyone whose first time it is. How do you know when you're ready to retire financially? How much do you need in your nest egg? Today, we'll take a look at the surprisingly simple math behind retirement and get to the heart of this answer. So if you find value in such information, please give this video a like and stay tuned for some math. Now, it may sound like a cop-out, but the answer is it truly does depend on each person's individual situation. A person can technically retire when they can live off the interest or appreciation or passive income of their investments without exhausting their principal. This number is simply not the same for everyone, as your monthly expenditures are unlikely to be the same as mine. Additionally, a person retiring today can count on Social Security, for example, to support at least some of their retirement expenses, whereas younger folks in my generation may not be able to count on this program existing at all, let alone in its current form, by the time we finally get to retire. Regardless of what you decide you need, there has been a rule of thumb known as the 4% rule, which is designed to let you know when your nest egg has grown large enough to support your current lifestyle. As the name suggests, this rule of thumb claims that you can quote-unquote safely withdraw 4% or 1/25th of the money you have at retirement each and every year without running out of money. For comparison, that's $40,000 per year per $1 million invested at retirement. So, is this truly a safe rate of withdrawal? Having heard this rule bouncing around, I wanted to explore it based on some historical data. Now, what I'm about to share is not a perfect analysis. But as I've always heard how the stock market has averaged just shy of 10% annually over its history, I was curious how such an investment would perform. At face value, one might expect that since this return is higher than our withdrawal rate, a 4% rate should be safe, even when accounting for inflation. Now, there are some very important caveats to consider when looking at the analysis that I'm going to be going through here. My analysis is looking at the historical value of the S&P 500 without considering dividends or contributions from Social Security, pensions, or other sources. For most people, it is unlikely, and in fact not recommended at retirement, to have all of your funds invested in a volatile investment such as the stock market. Rather, investments are usually diversified at retirement with a mix of stocks, bonds, and possibly other investment mediums such as real estate to minimize the volatility and downside risk. In fact, the study which initially gave rise to the 4% rule was based off a 50-50 split of stocks and bonds. So take all of this with a grain of salt. Nonetheless, I thought it was pretty interesting, so let's see how the 4% rule stacks up with an admittedly unreasonable 100% allocation in the US stock market, and whether this is the optimal withdrawal rate. Now, this video is admittedly going to get a bit technical, so please strap in for some numbers. I'll try to get through this as quickly and as painlessly as possible. I actually analyzed historical data since 1950, testing conservative withdrawal rates such as 3, 4, and 5%, but additionally looked at riskier withdrawal rates of 6, 8, and 10% to see how they fare for retirements ranging between 10 and 35 years. If we assume a retirement age of 65, this analysis would test whether or not your money would last you all the way until 100 using such a strategy. As expected, the 4% rule lined up perfectly, lasting 35 years in all 35-year periods since 1950. Of course, a more conservative withdrawal rate of 3% also supported 35 years of retirement in all cases. However, even if we bump this up to a 5% withdrawal rate, history suggests your money would last at least 25 years. And only about 14% of the time would someone run out of money within 35 years. However, once we get above 5%, the money quickly becomes much less likely to last, at least long term. While historically even 6 and 8% withdrawal rates have performed perfectly at 10 years, a 10% withdrawal rate would have run out of funds in multiple 10-year periods. Unsurprisingly, the higher the withdrawal rate and the more time your money needs to last, the more likely one would be to run out of funds. It is, however, important to note that because of the volatility inherent to the stock market, a few bad years, particularly early in retirement, can quickly deplete a portfolio, such that even if the long-term average is closer to 7 to 10%, lower withdrawal rates can still bleed you dry. However, as you can see, at first glance, the 4% rule holds water, even in an unreasonably aggressive retirement portfolio, such as 100% stocks. Of course, it is important to consider inflation, which is the reduction of buying power money has over time. Now, we have all heard stories of when a Coke cost a nickel or gas cost less than $1. Heck, even in my lifetime alone, I can look back and remember when I could walk into 7-Eleven and get a Slurpee for just 49 cents. While inflation fluctuates year to year, it usually falls around 2 to 3% here in the US, with the Federal Reserve targeting right around 2%. Because of inflation, if you were to continue living on the same amount of money year over year, in 35 years, your purchasing power would have been cut between 1/2 and 1/3 of what it is today. To combat inflation, we can simply change our withdrawal to keep our relative income equivalent to what it was where we started. For example, starting with a $1 million portfolio, a 4% withdrawal rate would be $40,000 in the first year. If we assume a 2% rate of inflation, the next year we would extract $40,800, or 102% of the previous year's withdrawal. Because this 2% inflation is compounding, in year 3 we now need $41,616. Again, just to keep up with increases in rent or the cost of milk or gas or whatever we're spending money on, without actually changing your quality of life. Accounting for this 2% inflation, let's see how our withdrawal rates perform. Now, this actually quite surprised me. Even assuming a low rate of inflation, the 4% rule did quite well, but it does begin to show instances where funds were depleted at 30 years. It's only a 5% chance after 30 years, but I do think it's important to consider whether one could stomach the risk of outliving their funds. Importantly, I think at least, a 3% withdrawal rate, again, has historically performed perfectly with not a single 10 to 35 year period failing to provide. One caveat here, anyone who began investing in 1999, right before the dot-com bubble burst, followed by the Great Recession, has not had enough time to evaluate these longer time frames, and this has performed worst of any 10+ year period, so this rate may not hold up long term. For anyone planning to retire for 30 years or more, withdrawal rates above 5% become extremely dicey, and even a 5% withdrawal rate has been a coin flip on whether or not it would have persisted for 35 years. While obviously accounting for higher inflation will further exacerbate the differences we've already seen, even if we account for 3% inflation, a 3% withdrawal rate has successfully navigated all 35-year retirement plans since 1950. Overall, withdrawing 4% per year continues to perform well up to 25 years, but will run out of funds 20% of the time by 30 years. For 25-year retirement plans, even increasing to just a 5% withdrawal rate will fail over 1/3 of the time, and not a single 35-year period has been able to accommodate a withdrawal rate of 8% or above. So how can we actually use this information? Well, it may sound morbid, but retirement is essentially an equation. How much do you need for the number of years you're going to live? While historical data does not guarantee future behavior, we can use this long, data-rich history to create a portfolio and withdrawal rate that meets your own personal risk tolerance. Although my analysis here analyzes up to 35 years out, the Social Security Administration suggested that in 2017, the life expectancy at birth in the US was 78.6 years, with women living significantly longer than men, at a little over 81 years of age versus a little over 76 years of age. For those who reach age 65, where my analysis began, about half will reach age 85. 1/3 will reach age 90, and only about 1 in 7 will reach age 95. So, as an example, history suggests that, accounting for 3% inflation, a 5% withdrawal rate would last 20 years 85% of the time. For someone who reaches age 65, they have approximately a 50% chance of living to age 85 and a 15% chance of running out of money if they do. In this situation, such a person would have a more than 92% chance of their money outliving them. Likewise, although a 6% withdrawal rate has historically run out of money approximately 50% of the time, given the 1 in 7 chance of living that long, the overall odds suggest they actually have a higher chance of their money outliving them at age 95, with this higher withdrawal rate, just under 93%. However, that same withdrawal rate has a 14.5% chance of them outliving their money at age 85. Even beyond this, there is a clear correlation with large drops in stock prices early in retirement and funds running out of money. I'll likely go through this in more detail in a future video, but using that knowledge, a larger safety net, say 12 to 24 months or more of living expenses held in an emergency fund, may allow retirees to ride out 1 or 2 large stock market corrections and live more securely. Now, I'm not claiming that there's a correct answer here, or that I have one, nor am I a financial advisor, so nothing here is meant to be advice, simply a thought experiment, which suggests that, overall, the 4% rule holds up pretty well. But for those wanting more security, a more conservative 3% withdrawal rate appears to be an incredibly safe option to ensure a stock portfolio will not run out of money over a 35-year retirement, particularly if one is planning to keep up with inflation. While an unfortunate fact of life is that many of us may not live to see 100. With average lifespans generally increasing, and movements like the FIRE movement causing people to retire earlier, retirement money may need to last longer than ever. If you're getting close to retirement, speak with a licensed financial advisor who is a fiduciary and will work in your best interest to ensure you have a successful, comfortable retirement. So with that, thank you so much for watching this video all the way to the end. I know it was a lot of data and numbers, but how much do you plan to spend in retirement? Leave me your thoughts in the comments section below. If you want to hear more about the FIRE movement and how it affects the 4% rule, or more information on personal finance, investing, and retirement, check out my other videos and consider becoming a subscriber. I am releasing new content every week, so check back soon for new videos. I'll see you in the next one.